Hello, this is Jan Lewis, Global Strategist, JP Morgan, January the 14th. That's a great start of the year, at least if you're in equities. Credit markets, commodity markets, bit flat. Bond markets not doing that great. Still, even in equities, let's not kid ourselves. It won't be that easy for the rest of the year. Yes, we're bullish. We have to recognize there is this battle raging between the bullish forces, which are largely global in nature. Economic data surprising on the upside. We're raising growth forecast. Profit data coming in strong. Uncertainty is falling. And risk assets are still on the cheap side. On the other side, on the bearish side, you have a number of local threats, primarily worsening balance sheets among local authorities, smaller countries in developed world, and inflation in the emerging market worlds. Which of these is going to win? We keep betting that the bullish force is going to dominate. So we stay long equities and risky assets overall. And clearly the last few weeks' worth of data have been good for that. We have to keep monitoring the bearish forces. So if we look at government debts and worsening credit quality, the whole danger is, of course, that authorities will be forced to clean up their balance sheets too quick. Now, what we expect is they will see a balanced reaction. Not too much spending cuts and tax hikes, tightening, because that would drag the world economy down, nor too little, because that would create much worse funding problems for local authorities. So, last week's worth of activity, let's say the first week, clearly not good. And, increasing funding problems for banks and sovereigns in European periphery. Policymakers seem to have gotten the message and clearly discussing what to do about this. We all have high hopes. There are tons of rumors around that ECOFIN and the summit over the next 2 weeks will provide solutions. We don't think they're going to be final. We think it's still going to be a muddled through year for the monetary union. So overall, we're not that optimistic yet, but neither do we think it's a major threat for the world economy. Then we look at US municipals, the state and local. Clearly, funding problems are worsening. The market's still open. It's getting harder and harder. Worse and worse borrowing conditions. Outflows from funds continue to accelerate or continue at the same pace. Not good news over there, and I think it's too early to jump into that market. What about emerging market inflation? Clearly, higher food prices and overall inflationary pressures in emerging markets will force monetary authorities to tighten. China tightened again this morning. So is this a big threat? Well, we do think the bond markets in Latin America and Asia probably underestimate the amount of tightening that is coming, but not by a mile. It's a somewhat bearish environment. We don't see a massive amount of rate hikes coming. So central banks will not totally stamp on the brakes. As a result, we're not really in a position yet to lower growth forecast over that. Add it all up, I'm still long equity markets primarily, high yield. Commodities too, although we're taking some profits given how fast the rally has been. And we're underweighting assets broadly that are affected mostly by these local threats. At times, these threats will start dominating and pull down the global equity market. We may have to pull back them ourselves a bit, but I think there's only an opportunity then later to get back in. I thank you.